Okay, everybody, we have a little change of plans today. Sandy's feeling a bit under the weather, and so Mark Chaikin, our founder and CEO and analyst extraordinaire, is going to be giving the presentation this afternoon. Mark, without further ado, I'll pass the program over to you.
Thank you, Sandy. Thank you, Dan, and apologies to those of you who were here to hear Sandy present the Chaikin Analytics story through her own voice. But I've lived and breathed this with Sandy for the last 5 years, and I'm actually very comfortable and flattered that I can tell her story. She is a bit modest, and this actually suits both of us. But she'll be back on next month's webinar. So the name of today's webinar is Invest Smarter with the Chaikin 5-Step Method. And what you're about to discover is how to be a smarter investor so that you can make more money. It's often said in Wall Street that to be successful you should follow the smart money. And I've created a whole series of technical indicators revolving around what I call money flow, which help investors and have been helping investors for 30 years follow the smart money by seeing the pattern of institutional money flowing in and out of a stock. Today's webinar is not about following the smart money, it's how to be the smart money, how to be a smarter investor. And I'm going to show you the 5-step method which Sandy has embraced, and this couple on the screen will have some relevance toward the end of the program when we make a special offer to everybody who's on. The whole purpose of investing in the stock market is to plan for your retirement and to buy yourself some freedom. Chaikin Analytics enables you to be successful in the market and spend less time on your research and more time doing what you'd like to do. And in this case, we love to see our family. This is my son Eric, who's deeply involved in the company, his wife, and my almost 4-year-old granddaughter. So for us, Chaikin Analytics gives us the freedom because some of the research is done for me in terms of the market letter that I write every Sunday. I'm not in the weeds researching hundreds of stocks. The Chaikin Power Gauge rating does that for me. And in the summers we like to go to the beach, and I can go to the beach and take my iPad with me and have the same tools that I have in the offices and the same tools that both individual and now institutional investors are using to make their investment decisions. So the opportunity for everybody on this webinar is now. It's never too late to take control of your financial future. It's never too late to become independent of advisors or Wall Street gurus or the people on CNBC who often have conflicting opinions. The time is now, and our mantra is you can do it. So here I am, not quite as pretty as Sandy, but Chaikin nonetheless. So why Chaikin, and more particularly why Chaikin Analytics? Well, this speaks to what I've done in my career, and as I mentioned, I've created a whole series of indicators to track the large institutional money flowing in and out of stocks. And this is really critical because the institutions drive the stock market. Been fortunate enough to be on CNBC and quoted in the financial press, and more particularly Barron's has reviewed our various product offerings very favorably over the last 3 years. So getting back to Sandy's story, Sandy was in marketing originally with Elizabeth Arden, L'Oreal, and then the Franklin Mint. And something she won't say on her webinar, she introduced the most successful men's fragrance ever, Draco Noir, as head of marketing and at L'Oreal. And along the way accumulated assets in 401k plans. But as is often the case with 401k plans, the only options she had were to invest in mutual funds. And actually the mutual funds, the Fidelity Magellan Fund and the Legg Mason Fund that was managed by Bill Miller, who outperformed the S&P for 18 years in a row, actually treated Sandy very well. They enabled her to buy her first house, and everything was going swimmingly. But then as she got deeply involved in her own marketing consulting business, and as she wanted to take the assets that had grown in her 401k plans to a professional manager, she engaged a professional investment advisor. And that investment advisor basically sold everything she had when he took over the account. And that, sadly, is a common thing. One of the stocks that was in Sandy's account, probably the only stock, was a company that her sister worked for called Airgas, which is based here in Philadelphia. And that stock ultimately went from 20 to 105 today. But as advisors often do, this particular advisor sold everything out of the account, including the mutual funds that she had, and invested in 10 new mutual funds. And then along came 2008, and I think we all know what happened then. Going back to the advisor experience, how many of you in the audience has had the experience of switching advisors or brokers and having them just sort of blanketly selling everything to create a clean slate? If you've had that experience, could you type Y in the question box, please? So I see that a number of you have had a similar experience, and that doesn't mean that all investment advisors are evil, but they just prefer to start with a clean slate and build from there. So in 2008, Sandy had a dialogue with her advisor about what was going on in the markets after Bear Stearns went under, and then rumors about Lehman Brothers started cropping up. And her advisor told her what every advisor, from the most experienced man at Merrill Lynch to the youngest rookie, said, hold, don't panic, don't sell. And the result was that Sandy's portfolio dropped by 40%, and she was paying a management fee for this. And this is fairly typical. Many equity portfolios in 2008 dropped as much as 50%. So Sandy decided to leave her investment advisor because paying a management fee to be down as much as the market averages just didn't make sense to her. And things worked out very well. This is a picture of our house in Connecticut. And I'm seeing our two dogs who are no longer with us, so this is a very poignant picture for me. But the markets, as we all know, rebounded, and Sandy and I decided to move from deep in the country in Connecticut to Philadelphia. And here's a picture of me 8 years ago when our house was still for sale, or at least was up for sale, and we were just about to buy it. And moving to Philadelphia turned out to be a godsend, because life has been good, and the stock market has rebounded, and we started Chaikin Analytics. But before we get to that, at the point in time that Sandy decided to leave her advisor, she had a problem. Who should she trust to manage her money? The challenge was, if she tried to manage it herself, there was just too much information to deal with. And this is a problem we all face every day in the stock market and in life. Check your email, check your inbox after a long weekend. Look at your Facebook or Twitter accounts or LinkedIn, and you see what I call information overload. I think this is a great chart. This is what we're confronted with in our daily lives, but as investors even more so, because part of what the internet has done is to make all the information about a company accessible on sites like Yahoo Finance and Google Finance and more specialized sites like FinViz. So all the information is out there, and anyone on this webinar can research a stock. Problem is, it takes about 2 hours to effectively research a stock, and that's if you know what to look for. And as we're going to see in a minute, there are certain pieces of information, we call them factors, that institutional investors look at every day. And it's important to look at these factors or pieces of information because the big investors are using them to make their investment decisions, and the reason they're using them is because they've been proven effective over a period of a lifetime. And for any investment advisor, whether he's running a mutual fund or individual accounts, they fall back on what works. So the challenge that Sandy confronted was too much information. And because of that, she decided to put her money into a Vanguard S&P index fund. And the solution that basically created was that her holdings were going to mirror the market. And as we bounced off the lows in 2009, that turned out to be a decent strategy. But late in 2009, I decided to start Chaikin Analytics because I felt that with the billions of dollars that individuals were moving out of full-service brokerage firms and away from advisors, just like Sandy had, to self-directed accounts at online brokers, that some portion of that money would flow into individual stocks. And I felt, based on 45 years in Wall Street, that individual investors didn't have the tools that they need to effectively manage the information and the emotions that are involved with investing in the stock market, particularly when you're managing your own money. So I started Chaikin Analytics, pulled together a team of people that I had worked with in the past with the goal of building on the success we had had in the institutional world when we created the first real-time workstation for portfolio managers and traders and ultimately sold that company to a subsidiary of Reuters, build on that success, which was primarily based on 1 or 2 technical analysis indicators. And we're actually going to see those indicators in the examples that we will be looking at very shortly. But I felt that I could do more, and in a sense, the Chaikin Power Gauge rating, which we're going to look at in a moment, is the summation of my 48-year career in Wall Street. It's gone way beyond technical analysis. But in order to take any proven methodology, you have to have a very disciplined approach to the stock market. So we've created a 5-step plan to success in the stock market. And the mantra that I like is, you can do it. I think Nike probably started that. But in the stock market, I think it's really important, whether you're managing your own money or whether you're using an advisor but watching that advisor much more closely than you ever did in the past, you've got to believe that you bring something to the table. Now, what we're going to be talking about today is how to manage your own money, how to find winning stocks, and how to avoid losers. And that's what this 5-step to success program is all about. You have to use a proven methodology that you can trust. And really, that boils down to having a plan. And having that plan based on something that you believe in and that has demonstrated that it can help you make money in the stock market. The second step is to play good offense, and that means putting the odds in your favor anytime you invest in a stock. One of the ways we do that is step 3, to use industry groups to find not just more winners, but better stocks with a higher probability of going up, and also using industry groups to know which groups and stocks to avoid. Number 4 is really important. You've got to play good defense. And playing good defense helps in 2 ways. A, it helps you avoid landmines, which crop up with more frequency than any of us would like in the stock market. But you can also take comfort in knowing that if you can just eliminate 1 or 2 losers in your portfolio before they turn into disasters every year, you're going to improve your investment results dramatically at the end of the year. Zach's investment research has documented that, and someone who writes for both TheStreet.com and CNBC actually wrote a piece in January where he talked about the fact that it's the stocks that you don't own that really matter. And by that he meant that if you can avoid a loser or two, sidestep some of these disasters that crop up periodically, A, you improve your investment results, but B, your psychology improves. There's nothing harder on Wall Street than having to deal with a stock that goes dramatically against you, particularly overnight, and we've seen many examples of that. And then finally, the fifth step towards success is knowing when to buy and sell. The first four steps are what I call the where and the what. Where is, how do I focus on the best stocks and the best industry groups? What is, which particular stocks meet all my criteria? And then when is the critical element, even if you're a long-term investor, knowing that you're buying at a reasonable time and at a reasonable price. So all of this boils down to what I think is the most important, or one of the two most important buzzwords for a successful investor. You need to focus. In life and in investing, focus is really the key to success. And in order to focus, you have to have a game plan and a disciplined approach. So we have a number of testimonials in the webinar today. We get these every day in our customer support department, in our inbox, and I feel that it's important to show you what other people are saying about Chaikin Analytics, not just what Sandy might be saying if she were on the webinar today or what I'm saying, but to show you what people, both professional and novice, have experienced using Chaikin Analytics. So here's a testimonial from Tom Lloyd, who's an author who just published a book on investing using fundamental and technical analysis, and blogs on marketwatch.com roughly once a week, and often talks about Chaikin Analytics. And his testimonial was that self-directed investors need a very structured and easy-to-use system that will keep them out of trouble. This speaks to that whole notion of playing defense. That's the way Chaikin Analytics was designed. So thank you, Tom. And another investor said, highly sophisticated investor, I sincerely appreciate Mark's effort to help the small investor gain access to his highly sophisticated stock market guidance for a very reasonable cost. And reasonable is really the key here. We have tools all the way from a free iPhone app to a workstation called Chaikin Analytics, which is for investors who are serious about their money and want to really take control of their own finances. But we have products in between at all price points of the spectrum. So let's start looking at these 5 steps. The first is to use a proven methodology. And for us at Chaikin Analytics, and for Sandy particularly when she went on her journey from novice to knowledgeable, the Chaikin Power Gauge is the centerpiece. It's a simple but powerful distillation of 20 factors that we're going to look at in just a second, down to a gauge that goes from very bearish to very bullish and uses color to reinforce. So green is good and red is bad, and in the middle is yellow, which is neutral. So if you've driven a car and you've come to a stoplight, you can understand the Chaikin Power Gauge rating. I like to say that the Chaikin Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. Now, what we're looking at here is a representation of the Chaikin Power Gauge rating with 4 components, and this happens to be a display of Comcast back in February of 2013 when the stock was $39.90 and had a very bullish power gauge rating. Comcast had a bullish power gauge rating off and on for over 20 months, and we're often asked whether Chaikin Analytics is for traders or long-term investors, and I like to say that it's for investors of all stripes and time frameworks because it gives you an edge by telling you the probability that a stock will outperform or underperform the market over the next 3 to 6 months. There's no guarantee there, but over and over again in the 3.5 years since we've released the Power Gauge to the public, the Power Gauge has proven itself effective in finding stocks to own and stocks to avoid. And I try to build this as a logical model. This is called a quantitative model, and group 20 factors into 4 components. So we have financial metrics, earnings, which is like a company scorecard, price volume activity, which is only 15% of the model. So those are the technical analysis indicators that I focused on in the early part of my career. And then what we call our secret sauce, expert opinions, or the sentiment of the smartest people in Wall Street. And the end result is the Chaikin Power Gauge rating, a clear, tested summary of a stock's potential. And a couple of these factors are really significant. I'm going to focus on just 3 of them. The financial metrics are what Warren Buffett might look at. And central to successful investing is knowing that if you pay too much for $1 of earnings, of revenue rather, you're basically putting yourself in harm's way. And we've just seen the social media stocks and some of the biotech stocks, both the good ones and the bad ones, sell off dramatically over the last 2 months after exhilarating moves on the upside. The problem is a lot of these companies had no earnings and were selling at a very big price to sales ratio. So one of them is an example we're going to look at later in the presentation, LinkedIn Corporation, which most of us know and use for a networking site, but basically doesn't earn any money. Their revenues are growing, but even with their revenues growing, LinkedIn sells at a very, very high price to sales ratio. And this was true for stocks in the software area and cloud computing area like Splunk, and even some of the retailers like DSW and Target and Lululemon. If you pay too much for $1 of revenue, I like to say you're on a high wire act without a safety net. And when you don't have a safety net, as soon as something changes for a stock, you're in harm's way. And that change can be a change in the market psychology, which is what we just witnessed with the biotech and the social media stocks. It can be a change in the company's fundamentals. There can be a competitor who comes into the marketplace, and we're going to talk about an example of that. It can be a problem that the company has, management upheaval. In the case of Lululemon, it was 3 problems, and Lululemon has been a disaster as a stock, even though it was a big favorite. The CEO resigned, the chairman of the board was selling stock, and the company had a problem with one of their big product lines, this overpriced exercise gear that they sell for yoga and Pilates people. And they had a sheer exercise pants, which turned out to be too sheer. And the stock basically has been going straight down for the last 6 months. And this is what happens when you pay too much for $1 of revenue. Lululemon was selling at over 12 times revenue, meaning for every $1 of revenue, let's say they had $1 million, the company was valued at $12 million. In this case, if they had $1 billion in revenue, the company was valued at $12 billion. It's just too much. So that's a factor that's very important, and it's one of only 20 in the model. And then we look at short interest and insider activity. And I know when Sandy does the webinar, she says that she relies heavily on the Power Gauge rating, but she also likes to look at the short interest and the insider activity. And this is partially because of her listening to some of my webinars where I talk about how the short sellers are the smartest people on Wall Street, paid to find fraud, overvaluation, stocks that are likely to go down. And it's not an easy job. And a lot of the short sellers were hurt last year in 2013 because almost everything went up in the stock market. But basically, short sellers are smart, and if they're going to stay in business, they've got to find stocks that are going down. So if the short interest is rising in a stock, that has a negative effect on the model. And then the last factor I'm going to talk about is insider activity, and this is really important. Insiders are highly incentivized with big compensation packages, stock options, golden parachutes, retirement plans, you name it. So when they step up and put their money on the line to buy a stock, how many of you on the webinar think you know why they're going to do that? If you do, type Y and then a short explanation as to what you think the insider is thinking when he decides to put his own money on the line. And it looks to me like we've got a fairly sophisticated audience, because you've got it right. When an insider buys his own stock, he does it for only one reason, because he thinks the price of the stock is going up. He's well incentivized otherwise, so when they make that extra commitment, go that extra mile, they're telling you that they have a strong belief that what's going on in the company is so positive that they want to put extra capital into their own stock. And so that's why we call expert opinions our secret sauce. And by drilling down on the power gauge, by tapping the component called expert opinions, you can see for any given stock the 5 different factors in expert opinions and see how they rank. So I know that when Sandy is looking to buy a stock, she'd like to see the short interest over here in the green, which means there's not a lot of short selling going on, and the insiders leaning toward the buy side. And that gives her an additional comfort factor. And we talked about focus, but there's another buzzword that really characterizes successful investors, and that's conviction. It's very important to believe in the methodology that you're using. That's step 1. And have a conviction that it's going to work day in and day out, month in and month out. Not every trade, not every investment, but that conviction level is what makes successful investors even more so, especially at the institutional level. I mean, think of institutional investors as gladiators fighting against themselves every day to outperform their peers. If they don't have conviction, they're going to get chewed up and thrown to the lions. So conviction is really important. And for Sandy, she starts with the power gauge rating. She looks for a rating that's very bullish, and then she moves on and just checks the short interest in the insider activity. So another testimonial from someone who's actually put up a Facebook page about Chaikin. What he says is, I keep shaking my head at how often this model gets it right. Now, this is an individual investor who's put up a Chaikin power page, and Dan O'Connor can weigh in and tell you the name of that later. But totally independent of Chaikin, he is doing options trading and options model portfolios based on Chaikin analytics. Another testimonial we got was that the Chaikin power gauge is my go-to guide. The returns that I'm realizing are all the proof I need that the model really works. Another way of saying that is the Chaikin power gauge is like a GPS for stocks. It guides you in the right direction, and it guides you away from the traffic and the congestion. Now, step 2 in this 5-step plan is to play good offense. And we've encapsulated the way you play good offense into a pattern we call classic bulls. It starts with a stock in a strong industry group that has a bullish Chaikin power gauge rating that's in an uptrend. And here we're looking at a 1-year chart of Cigna. Very important that the relative strength, how a stock is doing relative to the market, is green or positive, and we'll get into that in depth in a chart that's bigger that you can really see. And then finally the Chaikin money flow, which is what I made my name and reputation on, ideally should show as much green as possible. I talked earlier about following the smart money. Well, when you see the Chaikin money flow at these mountainous peaks of green, that's telling you that the institutional investors are buying the stock day in and day out. And it's nice but not necessary that that accompany a stock that you're interested in buying. So let's look at a stock that is currently exhibiting all the characteristics of a classic bull. So we're looking at Valero Energy, and this is a stock that we've been looking at off and on since 2012, and I think Sandy actually owned Valero at one point and has bought it again. But the key here is that as we look at Valero as of yesterday's close, we see a stock that's making a new high in a very strong industry group. The energy complex is very strong. Valero is a refiner that's in the miscellaneous oil group. And as we see, we'll see when we look at our list manager and we look at the strong and weak industry groups, the whole energy complex, which was weak all through 2013 and a good part of all through 2012 and a good part of 13, has now risen to the top. So it's like cream rising to the top. And going through this chart, notice on the bottom that Valero had been in a downtrend, performing rather poorly relative to the market. But in early October, the power gauge rating turned bullish when the stock was around 34, 35. The indicator above the power gauge, and that's every day, every week over the last year, is what we call the relative strength indicator. Now, both Investors Business Daily and Zacks Investment Research have talked about relative strength and group strength. What we've done is to convert this into a visual. Rather than making you sort of sort through a numbers table from 1 to 99, we try to make it easy and converted this into a heat map. So when the power gauge turned bullish, Valero was still underperforming the market. And there was some negative money flow, fairly substantial. So the institutions were selling the stock. But then in November, the stock started to move up. It broke out above a previous peak at around $40. And it started outperforming the market, and the money started flowing into the stock. And this is what we call that classic bullish pattern. When it rises above this previous peak, it's now starting to move into an uptrend. And then we see two green triangles on there, and these are the signals which we talked about as the fifth step in the plan, but we're giving you a little advanced look. It's what we call our oversold buy signals. So when a stock has a bullish power gauge rating, or in this case a very bullish power gauge rating, the question is, what do? Well, look for one of our signals to trigger, and we'll show you later in the presentation how we make that easy for you by pushing the signals on your list of stocks or enabling you to look at any list of stocks and see which stock triggered buy or sell signals in that list yesterday or the day before. So 2 days of signals. So Valero is an example of a classic bull. Here's another example of a classic bull, and this story does not have a happy ending right now. Express Scripts basically processes prescriptions for major pharmaceutical companies and hospital benefit plans. And the power gauge rating turned bullish in the early part of 2013 when the stock was trading at about 60. And when this chart was taken on March 18th, just a little more than a month and a half ago, Express Scripts had a bullish rating, was outperforming the market, and had tons of positive Chaikin money flow, which meant that the institutions were buying it. And it just had a very bullish article in Barron's magazine about the stock. And it had triggered an oversold buy signal in here at a price of about 73. So I think Sandy bought it back there, but somehow the market psychology for Express Scripts has changed. And even worse, the company reported a disappointing quarter last night after the close, and the stock was down 6% today when we took this chart for the presentation. So the question is, how do you manage a stock which is a classic bull that starts to go sour? And there are three answers to that question. The first one is that the power gauge rating turned neutral in late March when the stock was trading at about 74, which is roughly where Sandy entered the stock. So at that point, she was pretty much break even. But that's not an immediate call to action because the stock's still outperforming the market. But it's a red flag. Then we start to see the money coming out of the stock. And finally, over the last 2 weeks, the stock has underperformed the market. So a number of ways to get out of a stock like Express Scripts, which is an example of a classic bull that's gone sour. One is when it rallies back up to resistance, when it rallies from 70 back to 74, and you see that the Chaikin money flow is negative, and the power gauge is no longer bullish, you could reasonably say, I think I'm going to look elsewhere to make money. The first sort of exit that's most obvious is if the power gauge turns bearish. If you're in a stock and the power gauge turns bearish, or if you own a stock and you're new to Chaikin and you've got a bearish power gauge, that's a stock that you should strongly consider selling and moving out of your portfolio. And the reason is that there are 5,000 stocks in the market. And the stock market's a very interesting game, if we can call it a game. It's sort of like a baseball game where they don't call strikes. So you can stand up at bat as long as you want and wait for a fat pitch. And my friend Christopher Castroviejo likes to use that analogy, and he borrowed it from Warren Buffett, who's a big fan of Ted Williams. And anybody who knows baseball knows that Ted Williams was probably the most methodical, best hitter ever in baseball. And he was very analytical, and he waited for his pitch. And Warren Buffett uses that as an example. Has actually met Ted Williams before he died. I think Ted Williams is dead. If he's not, I apologize. And really admires the discipline that Ted Williams brought to the process of hitting a baseball. Same discipline applies to the stock market. If everything is not lined up, just pass on it. That also applies when you're in a stock and it goes south. You want to try and find an excuse to sell it at that point, not an excuse to hold it. And today's action, where the stock was down over 6%, is an example of why you have to be disciplined and get out of a stock before a piece of negative news like an earnings report that they issued yesterday after the close comes out. And it sure looks like the institutions knew or suspected that the earnings on Express Scripts were going to be negative, because look at all that negative money flow that was coming out of it. Now, there were stories about pharmacy benefit management and how profit margins were getting hurt, but basically Express Scripts reported a miserable quarter, and this is just no longer a stock to be in your portfolio. And then the final way to be in a sort of defensive investor is to say that you're not going to lose more than X in an investment that you make. And for most people, that number should be in the 10 to 15% range. And you probably shouldn't give back too much of your profits in a stock. You don't want to be too tight with that kind of thinking. But certainly when you buy a stock at, let's say, 73, as Sandy did, and it moves up to 78, you should move your stop loss order pretty close to what you paid for it. You don't want to let that profit erode and turn into a big loss, which is the case with Express Scripts. So how do you find ideas in Chaikin? Well, Sandy uses our list manager, and one of the tabs is called Chaikin Hot Lists. And in Chaikin Hot Lists are large cap stocks with bullish power gauge ratings, recent Chaikin bulls, which are the stocks that I've written up in our weekly market insights, which comes bundled with Chaikin analytics. Dividend champs, stocks that have high dividend yields and a bullish power gauge rating are always interesting, and stocks that have had recent upside and downside earnings surprises. So when we update that next week, you'll see Express Scripts in that recent downside surprise column. Some of the other lists within Chaikin are user lists, which you can create, the 65 industry groups that we'll look at in a minute. ETFs, which is a new capability that we added recently to enable people who trade ETFs to look at them in a very unique way, and like to get a feel for the people on the webinar as to how many of you trade or invest in ETFs. And I'm seeing a very, very good response, and that's typical of what we're seeing as we do these webinars. A lot of people are using ETFs as a way to invest in the stock market, try and outperform a pure S&P index fund by finding the sectors and the industry groups that are doing better than the market and likely to continue to do that. So one of the Chaikin hot lists that we think is very important, because we think earnings season is a fertile time to make money in the stock market, is a list we call upcoming earnings ideas. And on this list are the stocks that are due to report earnings in the following week that have either a bullish or a bearish Chaikin Power Gauge rating. And we're going to look at a chart, I think, of ConocoPhillips as we move along, and then a stock, LinkedIn, which has a bearish rating, that reported after the close today, and based on the initial trading where the stock was down after having been up all day, the response to LinkedIn's earnings was negative. The stock was down at 1.3 or 4% in aftermarket trading. But this is a very important list because there's opportunity in stocks that are due to report. At the very least, if you own a stock, be aware whether they're going to report earnings, because there's very increased volatility that comes right before and after an earnings report. And there's two ways that you can see what stocks are due to report. One is in the hot list, and the other is in our portfolio health check, where we actually tell you which stocks in your portfolio are going to report earnings in the coming week. And again, although we sell that separately, it's bundled with Chaikin Analytics. So here's ConocoPhillips, which, as we know from the previous slide, was due to report earnings this week. And another energy stock making a new high. This is in the integrated oil group. And ConocoPhillips responded very positively to their earnings report and spiked up to a new high, and highlights the opportunities and the pitfalls when we look at a stock like LinkedIn of investing or trading during earnings season. Now, a lot of traders say they don't go near a stock that's due to report earnings, and I respect that discipline because it helps you avoid the unpleasant surprises that often crop up when an Express Scripts reports. But using the Chaikin Power Gauge rating can give you a bit of an edge and enable you to have an informed probabilistic probability that the stock is likely to report positive earnings if it has a bullish power gauge rating, or disappoint if it has a bearish rating. Again, this doesn't work all the time, but it works often enough that it gives you a bit of an edge. So very often investors who are confident that a stock like ConocoPhillips and a strong industry group will report better than expected earnings will add to their positions ahead of that earnings report. Now, step 3 in the 5-step plan is to use industry groups to help put the wind at your back. So if you look at our list manager and tap industries, you'll see what we've been talking about, that the integrated oil stocks, the electric utilities, and the miscellaneous oil stocks are the 3 strongest groups. And the way we know that is we rank them based on the number of stocks in the group with a bullish or a neutral or bearish Chaikin Power Gauge rating. In the case of the integrated oil stocks, which include ConocoPhillips, 20 stocks had a bullish rating and none had a bearish rating. In the case of the miscellaneous oil stocks, 15 had a bullish rating and 3 had a bearish rating. And if we scroll down to the bottom of the list, we would see the retailers, which have been acting very poorly and probably should still be avoided, and other industry groups that reflect less potential than these 3 or 4 at the top of the list. So what we like to say is You can put the wind at your back by looking for the strongest industry groups, and this is supported by research that both Zacks and Investors Business Daily and William O'Neill have published over the years, that the strong stocks in the strongest industry groups outperform the weakest stocks in the weakest industry groups by a wide margin. And Zacks actually curates these 65 industry groups for us, but we look at it very differently than anyone else, and this is an edge that Chaikin gives you in both the industry group and the ETF analysis. Most people just look at the price momentum of an industry group. Has it been going up or down over the last 4 weeks, 12 weeks, 26 weeks? We actually look under the hood. Remember I said earlier that I view the power gauge as a Chevrolet with a Ferrari engine under the hood. Well, we like to look under the hood of an industry group or an ETF and see what the individual stocks look like based on the power gauge rating. If you've got an edge, use it whenever you can. So if we tapped on oil integrated, we would see what we call our watch monitor view of that industry group and their component stocks, and it comes up ranked by Chaikin power gauge rating. So the strongest drop in that oil integrated group is British Petroleum, BP. The third strongest is ConocoPhillips. And what I think investors should do is, in a very strong group like this, tap on that symbol and look at the chart, and then flip through the charts if you have our iPad app, or click on the next symbol if you have our desktop Chaikin Analytics app, and see what the charts look like. Do they conform to the classic bull pattern? Has there been a buy signal recently? Has there been a buy signal today, which would be even more actionable? So that's step 3 of our 5-step method for success. And here's what happens when you tap on a symbol. This is Imperial Oil, and the power gauge has been bullish since July, but it's been a sort of rocky move for a lot of these international oil stocks, and this stock has both outperformed and underperformed the market. But everything sort of kicked in gear just when this oversold buy signal triggered back in early March, when the stock price was trading at about 45. And it's moved up to 49, and again, this is in a market where the former leaders in biotech and in social media stocks have really taken it on the chin. And a lot of the technology stocks, including some of the ones that I favored, like Brocade, have taken it on the chin. What's leading the market now is the energy complex. So looking for a buy signal in an energy stock like Imperial Oil, ConocoPhillips, Valero, puts you into what I call a low-risk entry point. Doesn't guarantee that you're going to make money in the stock, but it does say that you're buying it smartly because the stock, in this case, has made a new 8-day low while the power gauge is bullish and money is flowing into the stock. So 3 things on your side, and the more factors that you have on your side, the more successful you're likely to be. So I mentioned that Barron's has been very kind to us. Mike Hogan, who writes the Electronic Investor column for Barron's, said that Chaikin is in good company. One way to locate a good stock is to locate the right industry. And Chaikin's approach recommends both specific stocks and industries to swap for weaker performers. He also mentions Zacks and Morningstar in that same article. So I think we're in good company, and Mike Hogan has reviewed a number of our product offerings. The one he was talking about was our Market Insights, which I write every week and is in your inbox on Sunday, which focuses on 3 strong and 3 weak industry groups, and then 3 stocks within each of those groups that stand out to me. And so this is a very efficient way, by reading Market Insights every week, to zero in on the strongest industry groups and look for potential buy candidates, and the industry groups to avoid. And these are stocks that you don't want to own. So step 4 in our 5-step plan to smarter investing is to play good defense. And playing defense translates into the mirror image of the classic bull, which is our classic bear. And here we use an example of J.C. Penney. And J.C. Penney had a power gauge rating which turned bearish back in 2012 when the stock was around 32, 33. And that rating stayed bearish all the way down to the bottom at around $6 or $7 a share. Recently turned bullish from bearish, but is now, I believe, neutral. And the reason this is a classic bear is because all of the factors that we were looking at to confirm a bullish stocks have been turned on their heads, and they're now red instead of green. So I talked about the fact that this is a product that appeals to both right brain and left brain investors. If you see a sea of red, if the power gauge is bearish and it's red down here at the bottom, if a stock is underperforming the market, as J.C. Penney did for almost 2 years, and our relative strength heat map is red, and if you see the institutions flowing out of that stock anytime they can, and by now I think you can confirm that these red troughs of money flow represent institutional selling. And if you see that, please type a Y in the question box so I know that I've made my point. One of the problems with doing webinars as opposed to live events is you don't get to look your audience in the eye and see their reaction to what you're saying. So I like to ask questions to try and engage people and make sure that the message is coming across loud and clear. So when all 3 of those factors are in place, bearish power gauge rating, stock underperforming the market, institutions selling, so Chaikin money flow is red, not green, look for sell signals. In this case, a relative strength sell signal would have been an excellent time to exit the stock, or if you're a trader, buy put options on a J.C. Penney. So that's our classic bear. And I said we'd look at an example of a stock where the game has changed. So we're looking at a 1-year chart of LinkedIn, which had been a very strong market performer all through the latter part of 2013 as the stock made a high up above 250. And I talked about price to sales ratio earlier. Even with the stock down from 250 to 150, LinkedIn is still selling at 12 times revenue. As of the last report, they had a $1.5 billion in revenue, but you were paying $18.5 billion in market cap for that. Again, you're on a high wire without a safety net. And LinkedIn reported earnings after the close today, and the stock is down about 3 or 4%. That's a pretty mild reaction. Normally, LinkedIn trades in 10% swings, either up or down, the day after they report. But if you look at this chart, you see that starting in early December, everything was in gear on the downside. LinkedIn had a power gauge rating turn bearish, was underperforming the market, and was in a downtrend. And how do we know that? Well, it made its peak in September, and it made a series of lower peaks and lower lows. So that's another way to know if the stock is something you want to be in on the long or the short side. If a stock is trading like Valero and making a series of higher highs and higher lows, that is a stair-step pattern, and that tells you that that stock is in an uptrend. On the other hand, LinkedIn is just the opposite. So when LinkedIn triggered an overbought sell signal in January at this upper volatility band under our long-term moving average, this was an excellent opportunity to get out of the stock if you owned it and if you trade options. And I'd love to know how many of you out there trade options. Again, a pretty decent number. It's a great time to buy a put option. And there was a second opportunity up here when the stock was trading close to 180 in mid-April with a lot of negative money flow. I remember I talked about the social media stocks being very weak as a group. LinkedIn is in the computer software and services area, but it's really a social media stock, and the industry group is weak. Money is flowing out of it, underperforming the market with a bearish power gauge and a sell signal. Now, I hope that I've convinced enough of you out there that if I ask you whether this is a stock that you would have bought or sold back here at 170, that the response you're going to type in is, this is a stock I would have sold or bought a put option on. And the stock dropped from almost 180 all the way down to 145 the other day on Monday. And this was the stock that I featured in my market insights on Sunday as my bearish stock of the week. And the reason was that I knew they were due to report earnings on Thursday after the close. And I felt that those earnings would be disappointing. But more importantly, I felt that no matter what those earnings looked like, unless they were absolutely sterling, that the stock would sell off, because the market has been sort of topsy-turvy lately. Stocks have reported positive earnings, and the profit-taking sets in, and then some stocks have reported negative earnings, and they just keep going lower. In the case of LinkedIn, they reported yet another loss. In fact, they swung from a profit to a loss in the quarter, even though revenues grew at 46%. And as I said, as of the aftermarket trading, LinkedIn was down about 3 or 4%. We'll see what it does tomorrow morning, but typically LinkedIn has a 10% swing on the day after they report earnings. So all of that added up for me as a stock that I could confidently feature as my bearish stock of the week. Now, another stock that I featured as a bearish stock of the week 2 weeks ago was Splunk. Splunk sort of captures all the buzzwords: big data, cloud computing. It's what the market has been looking at on the upside, and it had a big run from 20 up to 105. And here's a company, even as it's dropped 50% from 105 to 50, is still selling at 20 times revenue. At the peak, it was 40 times revenue. These are outlandish valuations. If you own the stock, Warren Buffett would absolutely take you to task. And you shouldn't own a stock like this unless you have a very, very tight stop loss. And as long as they're going up, they're wonderful stocks to own. But the second something goes wrong, and in this case what went wrong with Splunk is that the market psychology turned. All of these high-flying stocks with no earnings and big price-to-sales ratios have seen this kind of a hit, have seen this kind of a decline. Not all of them have dropped 50%, but if you think back to 2000, stocks dropped 85 and 95%. And it's possible that these companies with no sales, rather with no earnings and high price-to-sales ratios, can have much more downside risk ahead. There's no guarantee that down 50% is the end for stocks like this. There's no way to know. But why guess when you can find stocks with a bullish power gauge rating to invest in and avoid these stocks, or try and find put options that enable you to make money on the downside. And then finally, a third stock that I referred to earlier on as a bearish stock is a company that Sandy actually would love to like, because she buys shoes at DSW, which is a very value-oriented discount shoe retailer. It has both high-end and low-end styles. But after a brief flirting with a bullish power gauge rating in late October, which pinpointed a move from about 39 all the way to 47, power gauge rating on DSW turned bearish in late November at a price of about 46. And it's gone all the way to 32. Along the way, it started underperforming the market. Institutional money kept flowing out of it. There were a series of sell signals. Some were pretty timely, others saw the stock rally a bit. But the bottom line is this is not a stock that you wanted in your portfolio in this time period. There were plenty of other stocks to own that performed better than DSW. And the retailing sector was acting very, very poorly. So step 5 in this 5 steps to smarter investing is knowing when to buy and sell. And to help you with that, we have 6 pairs of buy and sell signals. We've seen 3 or 4 of them on the examples in the charts so far in the webinar. The first 4 require that the power gauge rating be bullish to get a buy or bearish to get a sell signal. The bottom 2, having to do with relative strength or relative performance of the market, don't require the power gauge rating to support it. And these are fully disclosed in our documentation on our website. Whether you're a subscriber or not, you can go see them. It's not a black box. We tell you how they are constructed. And it's a very powerful input, and it's step 5 to this 5-step plan towards smarter investing. Now, we'll look at a couple of examples of these signals in action. So Amgen is one of those biotech stocks that has taken it on the chin recently. But all through 2013, Amgen, a company called Biogen, Celgene, and Gilead Pharmaceutical, these are companies with real earnings and revenue. Case of Amgen, almost 19 billion in revenue, selling at a 17 price earnings ratio back here on March 18th. Relative strength buy signals triggered, and the power gauge rating was in the main bullish. But you don't see a lot of money flow, and eventually Amgen had a bit of a downdraft along with the other biotech stocks. The power gauge rating turned neutral, and this is a stock that will have its day in the sun yet again, trading at about 113, 112 and change. So it's had about a 10% drop, which compared to some of the stocks we just looked at like Splunk and LinkedIn and some of the lesser known biotech names without any revenue or earnings, that's not a bad performance at all. It's always painful to see a 10% drop in a stock you own, but there was ample evidence when the stock dropped below 120 and the money was coming out of it that this was a stock that you might want to take profits in, move to the sidelines. And in fact, that's what Sandy did. When she saw that sell signal, relative strength sell on 318, when the stock had rallied back up over 116, Sandy exited her long position, which she had entered into on this relative strength buy signal back here. And so she roughly broke even on the stock. Notice how the money is flowing out of it. If you can break even on a stock or lose $1 or make $1 on a stock that's breaking down, that's falling out of favor temporarily, where the institutions are selling it and the power gauge is turned neutral, you're doing pretty well, because on the winners, you're going to see some big upside. So another testimonial here, someone who's totally addicted to Chaikin. I'm now totally addicted to the Chaikin system. I may need an AA meeting if this doesn't stop. I actually hadn't seen this testimonial. Sandy put the deck together, and I'm sort of chuckling because in this case, addiction means better stock market and portfolio performance, not the need to go to an AA meeting. So to recap the 5 steps that we've gone into detail on, the first is to use a plan based on a proven methodology you can trust. Put the odds in your favor so you're playing good defense, and that starts with looking for stocks with a bullish power gauge rating. Use the industry group capability within Chaikin Analytics to find the best industry groups so that your percentage of winning stocks is higher at the end of the year. Number 4, play good defense. I can't stress how important it is to avoid the landmines and not guess, but invest with confidence in the best looking power gauge stocks. And then finally, we've looked at knowing when to buy and sell. So one of our subscribers, who's a long-term fan, said that my Chaikin Analytics subscription paid me back more than 11 times in 2013. By far the best investment I've ever made. And this is an investor who was struggling with the stock market, struggling to find a plan that she could effectively implement that she had confidence in. And Chaikin has given her that confidence. It's given her the focus and the conviction to invest profitably. Another testimonial says that Chaikin has made me enough money this week to buy a year's subscription for 15 people from my profits alone. And normally that would be about $30,000. But we're going to give you a special offer as we get to the end of the webinar so that as many of you as possible who aren't yet Chaikin subscribers can try this out. Finally, our exceptional customer support. We have an excellent customer support department and onboarding department. Paul Sherwood and Dan Franz are well known to any of you on the webinar who are Chaikin subscribers. And the comment was, your after-sales service has been exceptional. It's like having my own team of professionals behind me wanting me to succeed. And then finally, my favorite one, because this is a neighbor across the street in Philadelphia, and this is the justification for stepping up and paying for Chaikin Analytics, which is the workstation that generates the screenshots we've been looking at. Mark, I made enough money on Rite Aid and Green Mountain Coffee with Chaikin Analytics to buy that new car I've been dreaming of. And this is a neighbor right across the street from me here in Philadelphia. So what does the Chaikin Analytics package include? Well, it includes a free one-on-one tutorial that gets you started and shows you all the important features of Chaikin Analytics and how to use them. It includes all of the charts that we've been looking at on the webinar. It includes research reports on 5,000 stocks that are updated nightly based on the Chaikin Power Gauge, but which bring in some of those other statistics that you'd have to go to Yahoo Finance or Google to see. It includes our portfolio health check, which enables you to monitor your list of stocks or any list within the system. See which stocks have had changes in Power Gauge ratings, which stocks have reported a positive or negative earnings surprise. So if you had ConocoPhillips, you would see that on Saturday when this gets mailed out that they had reported a positive earnings surprise. If you had Express Scripts or LinkedIn on your list or in your portfolio, you would have seen that they had a negative earnings surprise. And then finally, it tells you the stocks that are going to report earnings in that list in the coming week. And we try to show you how important that can be. So a testimonial about Market Insights. Mark's weekly Market Insights works as my market trading GPS. The accuracy of the S&P 500 index level prediction is pretty amazing. And I might point out that I've been cautious on the market for the last 3 to 4 weeks for a whole series of reasons. And after 5 years of a bull market, it feels to me like the stock market is tired. It's not rallying on some of the good economic news that we're seeing. And when particular companies report good earnings in the main, we're seeing profit taking instead of rallies to new highs. And I've learned in 48 years on Wall Street that if the stock market doesn't rally on good news, you're in trouble. And then finally, another testimonial from an amazing actress turned trader. And she really is amazing. I've seen some of her trades in action. This is Rachel Fox, who has a huge following, not just on CNBC, where she's appeared 3 or 4 times in the last year, but in the blog and the Twitter world. And she started using Chaikin Analytics about 6 weeks ago. And she calls it a smart, amazing indicator. She said, I needed a cornerstone, a staple in my trading that I can turn to for confirmation. I found that consistent confirmation with Chaikin Analytics. It turned out to be so much more, however. I've used it to actually identify multiple trading opportunities, most of which have provided me with amazing results. And what's amazing about Rachel Fox is she's an actress who appears on Desperate Housewives. She's one of the baddies. And she's got a site called Fox on Stocks. And she's one of the best natural traders I've ever seen. She's now 17 years old. This screenshot is from a year ago on CNBC. And Rachel Fox has great trading instincts. She takes her losses quickly. She lets her profits ride. And now she's using Chaikin Analytics to find stocks like Amazon where she can go short with confidence whereas before she was relying solely on technical indicators plus her own research. And again, we go back to focus and saving time. For someone as busy as Rachel Fox, Chaikin Analytics has been a real time saver as well as a path to profits. We got a testimonial last week, and I'm not sure if Sandy's included it, that said, I've made so much on my short sales in Amazon, basically put purchases, that they will pay for my 2 months next year in Hawaii. My wife thanks you and I thank you. And anybody who's been to Hawaii recently knows that 2 months in Hawaii costs a heck of a lot more than $1,650. You can also contact Dan Franz, df@chaikinanalytics.com, or the number that's in your question box now, 877-MY-PORTFOLIO. And I talked about this being a risk-free offer. You have our 100% money-back guarantee. If you subscribe now and you're not completely satisfied within the first 30 days, we'll refund 100% of your payment. I think those of you on the webinar know how strongly I feel about our mission. Our mission to educate investors, level the playing field, and provide them with the tools that the institutions have been using for years. I really want you to try Chaikin Analytics because I think it'll help you make money with confidence and conviction and take away the fear and the anxiety that people experience when they invest in the stock market. So here's the quote from the investor who, or trader in this case, who made so much money on Amazon that we helped him pay for his 2 months next year in Hawaii. So if you don't have Chaikin Analytics, sign up today and try it out for 30 days. If you're not satisfied, we'll refund your money. But I feel so strongly about this, and I've said this in a webinar last week. Dan O'Connor, who runs our webinar program and is our host today and will now move on to the questions, and I worked together at a prior company. Dan felt so strongly about our mission 4 years ago that he left a major insurance company where he managed 5 different websites to join Chaikin Analytics because he believed in our mission statement. And our mission statement can be summed up in 3 words: you can do it. So with that, I'll turn this back to Dan and answer any questions that have come up in the course of the webinar.
Great presentation, Mark. Thank you very much. Yeah, we have a question here. Can you give a little bit of a demonstration of the overbought signals? Not sure if you went into those too much. Somebody was looking to see that.
Yeah, so let's look at some individual stocks. I've got a live version of the Chaikin Analytics for desktop working, and we talked about 6 pair of buy and sell signals, and you can click on them and see when they triggered over the last 12 months. So in the case of Amazon, which has had a bearish power gauge rating since mid-January, we had 2 overbought sell signals. One of them at about 360, and the stock did move higher but ran into resistance, and another one just the other day prior to a 40-point drop in the price of Amazon stock. And these signals are very simple. An overbought sell means the stock has made a new 8-day high, the power gauge is bearish, and the stock has gotten overbought in our proprietary overbought, oversold indicator. Overbought means that the pendulum has swung in one direction in a meaningful way, and oversold means that you've gone back and swung in the opposite direction. And the core of this is an 8-day high or an 8-day low, and to that I owe my friend Larry Williams, who came up with this concept years ago. And it's a very simple but effective way to trigger an exit or an entry in an individual stock.
Great. And how about the relative strength? I know you bring that up quite a bit when you're looking, we want to look at money flow, overbought, oversold. But on the relative strength, someone is asking, is there a time frame involved? In other words, how long should you be seeing good relative strength before you're confident in it? Um,
Yeah, that's a great question, Dan. So we'll start with the underpinnings of it. Uh, the relative strength indicator measures the performance of a stock versus the market over the last 6 months. So it's based on a long time horizon, relatively long for this type of an indicator. And as soon as it goes red, that's a red flag that says this stock is now exhibiting negative characteristics. So here we're looking at a chart of Lululemon on our desktop app. And along the way, when the power gauge turned bearish, the relative strength of the stock to the market also turned red or negative. And you can see the Chaikin money flowing out of it here at a price of around 68, 69, just before they reported a negative earnings report. And then we had two overbought sell signals. Now we also have relative strength sell signals that I like, and those were particularly timely. One over here about 5 days before they reported a very negative earnings report, and then another one just 7 trading days ago when the stock was around 52 on its way to 43. So the relative strength indicator, when it goes from red to green, as it did with Valero, so we looked at Valero in the demonstration. Here's Valero on the chart, and when the power gauge turned bullish in early October, the relative strength was still red or negative. When it went green in November, when the stock was trading at about 41 on its way to 58, that's all you need to know to confirm that both the model, which is our power gauge rating, and the market, which is the relative strength indicator, agree with one another. And when the model and the market agree, that's when you want to be buying the stock, and look what happened. Bingo. Oversold buy signals. What I call low-risk entries. Not guarantees that you're not going to lose money, but low-risk entries. The stock has pulled back and made an 8-day low, and the power gauge has stayed bullish. And if the relative strength is still strong and you see this big mountain of green, then everything is on your side.
Great. And how about, can you explain a bit about the alerts that come up for the various signals?
Yes, they're different on the desktop version than they are in the iPad. In the iPad, the first thing you see is the alerts dashboard. On the desktop, what you want to look for is the bell. So I'm going to click on the S&P 500. And now all the stocks in the S&P 500 are going to come up ranked by Chaikin power gauge rating. So General Dynamics, General Electric, Halliburton, right at the top of the list, Hess Oil, that's that theme of energy. And right next to what we call our power bar, which tells you the number of stocks in the S&P that have a bullish or bearish rating, there's a bell, and in this case it shows that there were 290 alerts. Now, not all those alerts are buy or sell signals, so we divide them up into bullish alerts and bearish alerts. So if you're looking for stocks to play on the downside, the bearish alerts are obviously where you'd look first. And a whole series of stocks like eBay and Kohl's and Darden Restaurants, DRI, and Paychex triggered sell signals yesterday. And then there were other stocks, Exelon in the utility group, IBM with a relative strength breakout, Archer Daniels, which has been a favorite along the way. And then it also shows you which stocks have seen a change in the power gauge rating. So the power gauge rating on April 30th turned bullish again on Apple. ACE, which is a company that's reported earnings this week, had a positive earnings surprise. So there's a wealth of information. Now, for most people, they'll be following a list of, let's say, 20 stocks. And it makes it really simple. So in this 20 stock list, there were no buy signals and no sell signals. The rest of them were just alerts. But I'm going to go to our model portfolio, the 20 stocks we liked going into 2014, and see if there are any signals there. And two sell signals, even though these are the stocks we like, in an insurance company and in Wyndham Hotels, and no buy alerts. So it's as simple as that. But guess what? Right at the top of the other alerts, Curtiss-Wright, which is in that list, reported a positive earnings surprise after the close on Wednesday. Their earnings came in 14% better than expected. If you click on that, the chart of Curtiss-Wright comes up, and we see that Curtiss-Wright was up 6.5% today in a down market. And it traded up to 68, which is pretty close to its old high. So, and this is a great example of the oversold buy signals. Stock with a bullish power gauge rating, tons of positive money flow. By the way, if you're an old-timer, you think Curtiss-Wright is in the aircraft business, but it turns out that they also supply the automotive industry with parts and the whole marine and industrial complex. So it's no longer a company that makes planes as it used to. It produces parts for a whole series of industrial products. So we gives you a description so you can see what this company does. They make valves for the Navy. But the key is, look at these wonderful buy signals. Now, the last one didn't work as well as the others, but the stock was contained at our volatility band. Money started coming out of it, but it was still outperforming the market. You might have been tempted to sell the stock, and I wouldn't say that was wrong, particularly if you had bought it up here. But if you bought it here or here, you didn't have much of a loss back here. You had about a 5% loss, which is well within our tolerance of not wanting to lose more than 10 to 15% on any given stock. And then occasionally you get a positive surprise, as you did with Curtiss-Wright, where the stock was up 6.5% today. So these indicators tend to point towards stocks that are likely to outperform and report positive earnings surprises.
Great. Should we take questions of looking at perhaps one or two stocks and then close it up? Or?
Yeah, I'd love to do that.
Great. Would anybody like to have Mark take a look at a stock? Just type in the questions. APAM. APAM.
All right, so here's a stock where we don't have a power gauge rating yet because we need a year's worth of data to compute the power gauge rating. But we see two things. The money's been flowing into this stock, which is positive, but it's been underperforming the market. So but we need 6 months of data for that. So that's really only valid going back here to December. And since December, the stock's been underperforming the market. Let's see what they do, though. And that's, I don't know this company. And I pressed the wrong button. Independent investment management firm that provides a broad range of global equity management strategies.
Okay. And how about GM?
Now, GM was on our favorite stocks for 2014, but then the power gauge rating turned bearish in February, and I replaced it on the list. And I'm glad you asked for that, because the power gauge rating was bullish in January when this stock showed up on a screen of attractive stocks, and the world changed for them. They've had product recalls, their sales have suffered, and when the power gauge rating turned bearish the last week in January, I replaced GM in our list with a stock that had a bullish power gauge rating, which was Comcast. And Comcast, that negative money flow relates to the merger arbitrage relative to their proposed takeover of Time Warner. So that doesn't bother me as much, and the stock has actually started to move up. If it breaks above 52, that'll tell you that the market thinks that they're going to get approval from the Justice Department, go ahead with that merger, and become one of the behemoths in both cable and internet access. If Comcast is able to complete their merger with Time Warner Cable, they'll have 35% of all the internet business in America. So I'd actually like to end with the ETF, Dan, because I think this is so powerful.
Great.
We have an ETF tab. You click on that tab and you see the 9, I look at the select spiders and then the subsector groups. There are 9 ways to carve up the S&P 500 in terms of sectors. Right at the top of the list are utilities. Right under that is energy. At the bottom are consumer discretionary and consumer staples. Those are the retail stocks. And then if you want to get more granular, you click on the subsectors and you see that at the bottom of the list are the home builders, which are in the retail sector, and some of the retailing stocks and the biotech stocks. But look what's at the top of the list. It's the oil stocks we've been talking about. So if you click on XOP, which is the S&P Select Spider ETF, you see a chart of that ETF with the relative strength line, and you see that just recently in mid-April the relative strength went from negative to positive, and now you've gotten price acceleration, and these are where the market leaders are. Here are your winning stocks. Conoco right at the top. Probably get down to some of the other names in the group that have been doing very well. Here's a stock that triggered a buy signal, a relative strength breakout yesterday, where the power gauge has gone from bearish to bullish. So the industry groups, and more particularly the ETFs, which reflect industry groups or sectors, are a very powerful tool. And those of you who are trading ETFs are going to get a totally different view from us than you do from anyone else. So with that, I'd like to bring up the last slide, which says that you're about to discover how to be a smarter investor. I apologize that Sandy couldn't be with you on the webinar, but she'll be back next week. And thank you all for attending, and hope that you've gotten value out of the presentation.
Thanks so much, Mark. Thanks everybody for attending today. The webinar was recorded. It's going to be sent out to everybody who registered. Thankfully, Mark was able to present from novice to knowledgeable. Invest smarter in 5 simple steps. Hope everybody has a great evening, and take care. Bye-bye now.